Welcome back to the deep dive. Okay, if you ever looked at a company earnings report and felt like, well, like you needed a translator, then this deep dive is definitely for you. Today, we are wrestling with what might be the most confusing quarter yet for D-Wave Quantum Inc. That's ticker QBTS after their Q3 2025 earnings came out.
Yeah, this specific set of numbers, it really presents a true financial riddle. You cannot take the initial headlines at face value here.
Right.
The core paradox is just so sharp, so counterintuitive. It really requires immediate, focused, critical thinking to figure out what's actually going on.
Absolutely, because when you look at the raw figures, they just seem to, well, violently contradict each other. On one hand, D-Wave reported really incredible top-line growth. Total revenue doubled.
Yeah.
I mean, up 100% year over year.
Which is huge.
Explosive growth, right?
Especially in a specialized capital-intensive field like quantum computing. But then you see the immediate problem. The number that causes, market panic. Their GAAP net loss, that's the official accounting loss, it widened by over 500%.
Wow.
Yeah, we're talking about a loss ballooning from roughly, $22.7 million last year to a staggering $139.9 million this quarter.
Yeah. It really is the ultimate financial head-scratcher.
Yeah.
I mean, how can you double your sales and yet increase your losses six-fold?
Right.
If you stop reading right there, you just assume the company is in total freefall. And that's exactly why we're here. That huge gap between operational success and accounting catastrophe really demands a detailed, structured, analytical approach.
And that's precisely our mission today. We're going to apply this provided 5-part framework to really analyze these results point by point. We have to act like, analytical detectives, you could say. Systematically separating the core business performance, how well they're actually commercializing their quantum systems from these non-cash accounting charges, which, particularly in high-growth, high-investment sectors, are often mandated by GAAP rules, but they completely distort the picture of true operational health.
That distinction, that difference between GAAP and non-GAAP is just the absolute foundation for understanding the quantum sector, isn't it?
Totally.
Tech companies, especially those deep in R&D, they pour vast amounts of capital into development, and, well, traditional accounting often struggles to reflect that growth properly.
Exactly.
If you only focus on that $140 million GAAP loss, you miss the entire story. The story of scaling, of investment, and actually increasing efficiency.
So we have to figure out, is the company fundamentally bleeding operational cash? Like, are their products just not profitable? Or is this massive loss purely an accounting phantom, something created by, volatile market conditions interacting with complex financial instruments?
Okay, let's unpack this then. Let's jump straight into the core data points that drove that initial market reaction. Hashtag tag section 1. Now for slide 1. The at-a-glance scorecard.
All right, slide 1.
Let's start with the market reaction, because that tells us exactly what the average investor saw, right?
Yeah.
And how they reacted to those top-line numbers. So following the November 6th, 2025 earnings announcement, D-Wave stock traded down 5.8%, settled around $29.22.
And that initial sharp negative move, it confirms exactly what we suspected. Most investors, and especially those automated trading systems, they saw the headline GAAP net loss of $140 million and just reacted really strongly to that negative number despite the clear revenue beat.
Right.
The confusion was immediate and, costly for anyone who sold right then.
And the revenue beat itself was significant. D-Wave reported total revenue of $3.739 million. Now compare that to the Wall Street consensus estimate, which was expecting only $3.03 million.
Yeah.
That is a substantial top-line beat. I mean, they generated 23% more revenue than expected. That's huge.
Yeah, that 100% year-over-year revenue growth translates into, a resounding success on the top line, no question. But the complexity, the source of all the confusion, and that stock dip, it lies entirely in the reported earnings per share, or EPS figure.
Okay, let's talk EPS. The official GAAP diluted EPS was reported as a net loss of $2.41 per share, 41 cents. Analysts were widely expecting a loss of only $2.07 per share, 7 cents.
Big difference.
That massive difference, that 500% miss on the bottom line, that's what tanked the stock temporarily. But we absolutely have to pause here and look closer at how analysts actually formulate those estimates.
Precisely. That consensus estimate of $2.07, that wasn't a GAAP figure. It was based on an adjusted or non-GAAP estimate. Sophisticated analysts, they knew that some major non-operational charges, stuff related to financing instruments, were probably on the horizon, so they discounted those in their forecasts.
Okay. So if we look at the true apples-to-apples figure D-Wave's comparable adjusted net loss, what was the actual result then?
Well, the adjusted net loss came in at $2.05 per share, 5 cents.
5 cents loss.
Yeah, think about that for a minute. Analysts expected an adjusted loss of 7 cents, and D-Wave delivered an adjusted loss of 5 cents. They actually delivered a smaller loss than the adjusted expectation.
Wait. So you're telling me that the core operational performance, when you strip out all that confusing accounting stuff, was actually a $0.02 per share beat?
That's exactly what the data confirms.
They outperformed the market's expectations for their actual business efficiency.
It was a 2-cent per share operational beat. It's just an incredible scenario where, operational success is completely obscured by an accounting requirement, and the result is a 5.8% drop in the stock price.
Wow.
The takeaway here is just crystal clear. Headline JAP numbers can be dangerously misleading, especially in the quantum space.
Yeah, you really have to look under the hood. Yet, despite that initial turmoil, the broader analyst sentiment didn't immediately just turn negative, did it?
No, it didn't. Overall sentiment remains pretty solid. It's at moderate buy with a recommendation score of 1.9, on that 1 to 5 scale. This signals that the experienced analysts, the ones who really understand the mechanics we're about to dig into, they already filtered out the noise. They saw the operational strength and the fact that the business is actually scaling faster than expected.
All right, now we have to tackle the absolute heart of the matter, explaining that widening gap loss. Let's look at those brutal raw numbers again. Revenue doubled to $3.739 million. Net loss widened by 516.4% to almost $140 million.
Okay, before we explain the massive accounting driver behind that, we should probably clarify a related point of confusion for a lot of listeners, the difference between basic versus diluted EPS.
Good point. Yeah.
It's important context for why that final loss number looks so incredibly big.
Okay, let's unpack this. What's the distinction? Basic versus diluted. Lay it out for us.
Sure. So basic EPS, that's the simplest measure. It's just net income or loss divided by the weighted average number of shares actually outstanding right now. Simple division.
Okay.
Diluted EPS, however, that's the metric sophisticated investors really focus on because it represents a kind of worst-case scenario.
Right.
It calculates the loss, assuming that every single piece of paper that could potentially turn into a share, things like employee stock options, maybe convertible debt, or, critically for D-Wave, warrants, were immediately exercised.
So it basically forces the company to account for the full potential risk of shareholder dilution down the road.
Precisely. That potential influx of new shares or dilution, it spreads the loss across a larger share base. And that's why the diluted EPS loss of $2.41 was so much wider than the previous year. It accounts for more potential shares and, as we're about to see, a much, much bigger loss number overall.
But the real driver, the absolute monster behind that $140 million figure, is the accounting treatment itself. We are talking about the primary driver. The $121.9 million non-cash warrant charge. This is where the story gets really, truly counterintuitive.
It really is the gap paradox in action. So first, let's quickly define warrants. A warrant is essentially a long-dated contractual right. It gives the holder the option to buy QBTS stock at a fixed price, often tied to their SPAC debut or other financing rounds. They're a pretty common financial tool used in early-stage financing.
Okay, so a fixed price option to buy the stock. Now, what happens when D-Wave's stock price appreciates significantly in the market, which it clearly did leading up to this quarter?
Right. When the stock price rises, the value of that warrant, that right to profit by buying low, it increases dramatically. Now, here's the key gap rule. D-Wave is required to classify these warrants as liabilities on their balance sheet.
Liabilities, right?
Yeah.
Liabilities.
Because they're instruments that could, theoretically, force the company to issue stock or maybe even pay cash in the future.
Got it. And liabilities have to be periodically remeasured, right? Mark to market.
Exactly. GAAP mandates that D-Wave must record the increased theoretical value of these warrants as a liability. And that increase in liability, in this specific case, $121.9 million, that has to then be passed through the income statement as a non-cash expense, or in this case, a non-cash loss.
Okay, let me just make sure I and you, the listener, understand this correctly. D-Wave is essentially being penalized on paper because their stock price went up.
That's absolutely correct. It's bizarre, but true.
Their market success triggers a mandated accounting loss.
It sounds crazy, but yeah. If the stock had actually dropped, D-Wave would have recorded a non-cash gain. But because the stock performed well, the potential obligation to the warrant holders increased, and that $121.9 million charge is the direct result.
Wow.
The press release explicitly confirms this was a non-cash, non-operating charge related purely to the remeasurement of that warrant liability. And most importantly, it did not cost the company a single dollar of actual cash flow.
Okay.
It is entirely an accounting phantom.
That is the absolutely crucial distinction. If you just mentally strip out that $121.9 million, that $140 million loss suddenly shrinks dramatically. It brings it much closer to last year's operational loss, or maybe even better, as we're about to discuss.
But we also need to acknowledge the secondary driver, investment and growth. Because while the headline loss was largely phantom, the company is still spending real cash to expand. It's not all accounting tricks.
Right, good point.
Their GAAP operating expenses, they increased by 40% year over year. That's up to $30.4 million.
Okay, that 40% jump, that's real cash being spent.
Yeah.
What was driving that operational expenditure increase?
Well, it was planned investment, really designed to support future revenue growth. About $4.1 million more was spent on personnel costs, hiring new sales teams, more engineers, R&D specialists, that kind of thing.
Makes sense.
And another $2.9 million more went into fabrication costs, which is absolutely necessary for building those next generation quantum chips and, maintaining their current fleet of systems. This is necessary spending that actually confirms they are executing their growth strategy.
Okay, so slide one synthesized. The market saw a terrifying $140 million loss. But the detailed reality is that $121.9 million of that was totally non-cash accounting, driven purely by their own stock appreciation.
Right.
The core business actually beat revenue estimates and is making necessary, planned, real cash investments for future scale.
Hashtag tech section 2. Moving to slide 2, the engine of profitability.
All right, slide 2.
So now that we've successfully kind of quarantined that massive non-cash charge, we can shift our focus completely away from the misleading headline loss.
Yeah.
We need to analyze the underlying engine of profitability and operational efficiency. Does their business model actually get better as they sell more quantum systems? That's the question.
This is where we look for that operating leverage, right? Is the cost of generating each dollar of revenue actually falling? And we look first at gross margin analysis. That's the purest measure of core business health before all the operating expenses like R&D and SG&A hit the books.
Exactly. Gross profit is just revenue minus the direct cost of goods sold. And D-Wave's gross profit, well, it surged 156% to $2.7 million. That is a massive number.
Wait, hang on. 156% profit growth versus 100% revenue growth. That is like the statistical definition of improved efficiency, isn't it?
It absolutely is.
The growth in profit is accelerating faster than the growth in sales.
Yeah, it clearly shows that D-Wave is moving past that really early stage, super expensive R&D production phase and more into a scalable commercialization phase. Their GAAP gross margin expanded significantly. It moved from 55.8% in Q3 2024 to a really robust 71.4% this quarter.
Wow, a jump from roughly 55% to over 71%. That's extraordinary. For a hardware-heavy company in just 12 months, it really suggests they've either drastically reduced their manufacturing costs, or maybe they're successfully selling higher value, higher margin contracts.
Well, management actually provided some clarity on this. They attributed the margin improvement directly to the upgrade they completed at the Jülich Supercomputing Center in Germany, which involved shifting that system to the new, more powerful Advantage 2 processor. This strongly suggests that their newest product line, that Advantage 2 architecture, is just inherently more profitable to deploy and operate.
Okay, that's a really crucial strategic insight then. It validates their continuous R&D investment. They aren't just selling more of the same old tech. They're selling a newer, better version that actually yields significantly higher margins.
Right.
That's often the sign of a healthy technology pipeline, right? New products solving old cost issues.
Exactly. And we can actually delve even deeper by looking at the non-GAAP figures again. Remember, we use non-GAAP to strip out those non-cash items like stock-based compensation and depreciation, giving us the clearest possible picture of the core operational mechanic.
Okay, so if we look at the non-GAAP gross margin, what does that efficiency metric show us? How good does it look there?
Well, their non-GAAP gross profit hit $2.9 million. That's a 131% increase year over year, again, outpacing revenue growth. And the resulting non-GAAP gross margin reached 77.7%.
77.7%.
Yep, expanding sharply from 67.2% last year. Now, to put 77.7% in perspective, that actually places D-Wave's profitability metrics kind of in line with mature, high-margin software as a service companies.
Wow.
Even though they're selling highly complex proprietary hardware.
That is a genuinely staggering operational achievement. A 77% non-GAAP margin suggests that once they cover the fixed costs of R&D and infrastructure, the actual cost to deliver incremental quantum solutions is surprisingly low.
Absolutely. Which now brings us to the adjusted bottom line. This is the crucial figure that really proves the operational story we've been building. We know the official GAAP net loss was that distorted headline of $140.0 million.
Right, the scary number. But the figure that truly reflects D-Wave's operational efficiency, the adjusted net loss, which carefully excludes that $121.9 million non-cash warrant charge, what was that number?
The adjusted net loss was $18.1 million.
$18.1 million adjusted loss. Okay, how does that compare to the comparable operational loss from a year ago, Q3 2024?
Okay, here is the aha moment. The moment that should really reassure any skeptical listener. The adjusted net loss in Q3 2024 was $23.2 million.
$23.2 million loss last year.
Right. So the underlying operational loss has actually shrunk by 22% year over year.
Okay, we really need to let that sink in for a second. Revenue doubled. Gross margin expanded dramatically from 55% to over 71%. And at the same time, the actual cash burn loss, when you adjust for all that accounting noise, it decreased by 22%.
This is powerful textbook operating leverage in action. It means that the infrastructure and the R&D costs they incurred in previous quarters are now supporting substantially more revenue without a proportional increase in costs.
Right.
They are successfully generating revenue faster than their non-variable operating expenses are increasing. The efficiency improvement is measurable, and it's significant.
So if you're betting on the long-term success of this company, this 22% shrinking operational loss is probably the most important validation point in the entire report.
I'd agree with that.
It confirms the business model is working and is scaling efficiently, completely refuting the narrative implied by that $140 million headline loss. #tag section 3, transitioning to slide 4. Financial strength and shareholder rewards.
Okay, moving to slide 4 now.
Operational efficiency is obviously mandatory, but in a race as expensive as quantum computing, you absolutely need deep pockets. You need a long runway, right? To sustain the years and years of R&D required to maintain technological leadership.
Absolutely.
So we have to turn our attention now to the balance sheet to assess their funding security for future growth.
Right.
Because cash is king when your operational metrics, even though they're improving, still show an adjusted loss.
And this section, slide 4, it provides the clearest and most unambiguous good news in the whole report, really. D-Wave ended the quarter with the highest cash balance in company's history at an astounding $836.2 million.
That is just a colossal number, especially when you think about where they were just 1 year prior. How staggering is that increase exactly?
Well, the cash and cash equivalents balance is up over 2,700% from $29.3 million just 12 months ago on September 30th, 2024.
2,700% increase in cash.
Yep. They successfully raised and locked in a monumental financial war chest during this period.
Okay, that cash balance obviously de-risks the entire enterprise. But the critical question for, the discerning investor listening is, how was this cash generated? Was it from internal profitability or was it all external financing?
Yeah, good question. It was almost entirely external financing, which, given the stage of the company, is totally appropriate. The cash flow from operations actually used $53.6 million in the quarter.
Okay, so they burned cash operationally.
They did, which is expected for a company that's aggressively building out highly specialized hardware and huge R&D teams. They are burning cash to grow, but the rate of that burn, as we just saw with the 22% shrinking adjusted loss, is actually decreasing, which is key.
Got it. So the $836 million came from financing activities. Where specifically did those hundreds of millions flood in from? What were the sources?
Primarily two key sources. The first was a staggering $536.7 million generated from at-the-market offerings, often just called ATM offerings.
ATMs.
This is a financing tool that allows a company to sell new shares directly into the existing public market over time, rather than doing a massive block sale all at once.
Okay. Why is an ATM offering a strategic move for a company like this, a potentially volatile high-growth stock?
Well, it's really tactical financial management. By using an ATM, D-Wave was able to capitalize on their increasing market valuation. That same valuation increase, by the way, that triggered the phantom loss we talked about.
Oh, the irony.
Exactly. They used it to systematically raise capital at higher and higher share prices over time. It minimizes the shock of dilution compared to a big offering, and it allows them to raise capital exactly when they need it, essentially turning a rising stock price directly into immediate funding for their R&D budget.
So they successfully leveraged their market momentum directly into fresh capital on the balance sheet.
Precisely. Now, the second major source of cash was $139.2 million generated from the exercise of warrants. Now, remember that $121.9 million non-cash loss we analyzed earlier?
Yeah, the liability.
That was the liability recorded because the stock went up.
Right, the non-cash penalty for success, as we called it.
Well, the exercise of warrants is the cash inflow benefit of that same success. When the stock price rises significantly, warrant holders are incentivized to actually exercise those rights. They pay D-Wave $139.2 million in cold, hard cash to acquire those shares at the predetermined fixed price.
Ah, okay, so the very same financial mechanism that created the phantom $121.9 million liability on the income statement also generated $139.2 million in real necessary cash to fund operations on the cash flow statement.
That's it exactly.
That is an incredibly important context for the investor to understand. It's two sides of the same coin.
It perfectly illustrates the dichotomy, doesn't it?
Yeah.
The accounting rules force them to record a loss on paper, while the actual market activity stemming from the same event provides a massive, real cash injection.
So what does this huge $836.2 million cash balance mean practically for D-Wave over the next, say, several years? What's the runway look like?
Well, it provides immense financial security. If we compare that total cash to their quarterly adjusted EBITDA loss, which is a very conservative proxy for their operational cash burn, that loss was approximately $20.6 million.
Okay, $20 million burn per quarter, roughly.
Roughly. So doing the math, they have secured capital for many, many quarters, potentially years, without needing to go back to the volatile capital markets anytime soon.
Wow.
This completely de-risks the enterprise from immediate concerns about financing and allows management to just focus purely on R&D, commercial expansion, and, winning the long-term quantum race. It allows them to aggressively pursue that dual-track strategy we'll talk about.
#tag section 4. Finally, slide 5. The road ahead management's outlook and key takeaways.
All right, the final stretch, slide 5.
We've thoroughly dissected the accounting, the operations, the balance sheet, separating fact from phantom. Now we really need to look forward. What is management's outlook, and how does all this financial output connect to real-world commercial momentum? Is the business actually growing?
Yeah, and CEO Dr. Ellen Baras's commentary directly framed these financial results as validation of their ongoing strategy. He emphasized, and I'm quoting loosely here, that their strong third-quarter results reflect the momentum we see building across every aspect of our business.
Okay.
And he deliberately pointed to the key operational metrics that we highlighted: revenue, gross profit, bookings, and of course the cash balance, as clear indicators of accelerating global quantum computing adoption.
And what about the strategic focus? What's the core balancing act for D-Wave right now? What are they trying to achieve?
Well, their core strategy is really twofold. First, delivering quantum computing value now, today, through their specialized annealing systems to businesses, researchers, and governments.
Okay, the current tech.
Right. Second, simultaneously advancing the next-generation gate model technology for future, broader applications. So they're monetizing their current technological lead while aggressively developing the future tech required for, universal quantum computing.
Okay, this brings us to a crucial point of technical clarity. Because for our listeners who might be new to quantum architecture, D-Wave's famous for its annealing systems. What exactly are those, and how do they differ from the gate model technology that they're also developing?
Good question. So D-Wave's current Advantage 2 systems, they use quantum annealing. This is a type of quantum computation that's highly specialized for complex optimization problems. Think logistics, scheduling, financial modeling, materials science simulations.
Finding the best answer among tons of possibilities.
Exactly. They are fantastic for finding the absolute best or near best solution among billions or trillions of possibilities very quickly. Now, the gate model approach, on the other hand, which is what companies like IBM and Google are primarily pursuing, aims for universal, all-purpose quantum computation.
Okay.
It's kind of the difference between a specialized high-speed tool, like an annealer, and a general-purpose quantum supercomputer, the gate model. D-Wave is very successfully monetizing the former while investing heavily to build the latter.
That dual approach sounds incredibly resource-intensive, but maybe necessary for long-term relevance.
It absolutely is resource intensive. But the operational success we saw, that shrinking adjusted loss, those high gross margins, that's what's helping to fund their entry into the much broader gate model race.
Okay, let's synthesize everything we've covered now into the 4 key takeaways from the analysis. This structured synthesis is essential, I think, for ensuring the full, nuanced story sticks with you, the listener.
Agreed. Takeaway number 1, probably the central lesson of this entire deep dive. The headline loss is misleading. The adjusted beat is real. We just have to reemphasize that $121.9 million non-cash charge.
Right.
It created the massive job loss. But the real operational story was the beat on revenue 23% above consensus, and the fact that the actual operational loss was smaller than analysts expected. The optics were terrible, but the underlying performance was actually strong.
Okay, takeaway number 2 focuses on the underlying business viability. Core profitability and efficiency are improving rapidly. This is proven by that dramatic margin expansion. GAAP gross margins jumped from 55.8% to 71.4%, largely thanks to the higher profitability of their new Advantage 2 systems. And crucially, the operational loss shrank by 22%, confirming powerful operating leverage is kicking in.
Takeaway number 3. The balance sheet is a fortress. That record, $836.2 million in cash, it was raised tactically through sophisticated capital market activities, those ATM offerings, and the exercise of warrants. This provides a multi-year runway, completely de-risking their expansion and R&D plans and insulating them from market volatility for quite some time.
And finally, takeaway number 4, which connects the financial numbers back to the actual adoption on the ground. Technical and commercial momentum is driving the numbers. The financial success isn't just financial engineering, it's the consequence of measurable, tangible business breakthroughs.
Exactly. And we saw concrete examples of commercial momentum that validate this spending. They specifically highlighted a substantial 10 million booking expected in the fourth quarter for an Advantage 2 system in Italy.
10 million euro deal, that's significant.
Yeah, it demonstrates the large deal pipeline, especially for government and research clients, is robust.
And maybe even more compelling is the diversification of their customer engagements. It shows that annealing systems are finding real-world value now. They named a major U.S. airline, presumably for optimization tasks.
Logistics, maybe scheduling.
Right. BASF, a huge global chemical company, likely for material simulation. And critically, they mentioned the North Wales Police.
Yeah, that North Wales police engagement is fascinating, isn't it? It suggests adoption is moving far beyond the traditional academic or government research lab.
What would police use it for?
Well, law enforcement agencies could potentially be using annealing for really complex resource allocation problems, maybe optimal officer scheduling, or finding the most efficient patrol routing, things like that. This shows the market for applied optimization using quantum computing is expanding into non-traditional pathways, which is absolutely crucial for long-term commercial scalability.
Yeah, broadening the use cases. And while they monetize these annealing systems, they're also making necessary progress on the future tech, right? They reported continued advancement on their gate model technology, specifically leveraging fluxonium qubits. What's the significance of fluxonium? Why mention that?
Fluxonium qubits. They are a specific type of superconducting qubit known for their enhanced coherence times. Basically, they can hold quantum information longer before environmental noise messes up the calculation.
Which is good.
Which is absolutely essential for building a scalable, fault-tolerant, universal gate model computer. Their focus on fluxonium shows they are genuinely dedicated to the deep technical breakthroughs needed to compete with the industry giants like IBM and Google in the long run, even while they enjoy commercial success with their current annealing products.
Okay, so bringing it all together then, the final narrative really proves the critical necessity of doing this kind of deep dive. The market's immediate negative reaction proves that headlines and that simplified gap loss figure just dominated the initial conversation.
But our structured analysis, hopefully, shows a much clearer picture. The operational data actually validates management's narrative of accelerating adoption, high margins developing, and really strategic financial positioning. They doubled revenue, they improved margins dramatically, and they reduced their true operational loss, all while this complex, non-cash accounting quirk temporarily obscured the actual picture of health.
And that structured approach, understanding the difference between non-cash liabilities and true cash burn and moving beyond just surface-level news, it's a repeatable and necessary method for assessing any investment, really, but especially in these highly complex, high-growth sectors where GAAP accounting can sometimes lag far behind market realities.
Yeah, it's not just about what the numbers are, it's about asking why they look the way they do, and maybe recognizing that sometimes market appreciation can actually appear as a loss on paper. Strange, but true.
Which leaves us with one final provocative thought for you to consider as you leave this deep dive today.
Reflect on the nature of complex financial reporting in high-growth tech. If a company's stock appreciation requires it to record a $122 million non-cash charge related to warrant liability, is that truly a loss in the traditional sense? Or is it actually confirmation of a successful market valuation, just one that's interpreted negatively by perhaps outdated accounting standards? Something to think about.
Remember, this report is for informational purposes only and does not constitute financial, investment, legal, or tax advice. All investment decisions should be made based on your own research and in consultation with a qualified financial professional. While efforts have been made to ensure accuracy, no guarantee is provided. This report was generated by an artificial intelligence model integrating official company data with publicly available market data.
Like and subscribe to StockAnalytics.ai YouTube channel. Members get access to our library of S&P 500 stocks and NASDAQ 100 library we're building out, and also get priority requests for company deep dives.